Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, as we come towards the end of the year and every year, we tend to get predictions on what the next year holds for the financial markets. You are very familiar with them. I'm sure you've seen them most recently. The three stocks you must own, what the market will do in 2023, what bonds will do, what the real estate market, how things will perform. I mean, the reality is everyone's taken in my opinion, their best educated guess, which is fine, but it's a very difficult, proposition to forecast what is going to happen, particularly since there are so many issues out there, geopolitical issues, of course, a softening economy, with social media, one tweet, if you will, could roil markets. So I would say take those things with a grain of salt in terms of predictions. But I wanted to share some information on an investor who is quite well known, and he tends to be pretty bearish, and I'll get to that in a minute. But this legendary investor's market forecast is interesting, and let's go into why. Well, before we do that, the gentleman co-founded the Quantum Fund in 1973, which was actually at the time in the middle of the bear market back then. And from 73 to 1980, his portfolio returned an astonishing 4,200%, while in comparison, the S&P rose 47%. Now, by any standard, that is a phenomenal relative return. And yes, it's some time ago, but I don't want to because it was some time ago, mitigate his success. Well, who was this gentleman, or who is this gentleman? His name is Jim Rogers. You probably see him on various financial, let's call it publications or TV. Well, last year, he said the next bear market will be the worst in his lifetime. Now, it's important to note that Jim Rogers tends to be quite bearish for years. So again, just keep that in mind. And I noted some years and what he's particularly said. You could see he tends to be quite bearish, and some people could argue he's what's known as a perma bear. So for example, in 2013, he said you better run for the hills when referring to the equity markets. In 2015, he said we're overdue for a stock market crash. So someone like this, again, has done well in the past, but someone like this, you have to understand what their tendency tends to be, if you will. So you want to get all sides of the coin, get, in my opinion, the totality of the information, and make an educated decision based on where we are in the market cycle and how it pertains to you. But what's important to note, and this was the headline we just looked at, what's important to know that Jim Rogers said the next bear market will be the worst in his lifetime, back when the market was peaking. So last year in October, in fact, October 25th, this is where this blue arrow indicates. Of course, this is the S&P 500. Again, you notice this is in the fall of 2021, right about at the market peak. Now, he was specifically referring to the bear market. Of course, as you know, we talked about this on the last some videos. The bear market is a decline of an indice from the peak of 20% or more. So technically, and again, I noted this earlier, the S&P and the NASDAQ are in a bear market. The Dow is not yet. The Dow is off around 8-9% from the highs earlier this year. So technically, we're in bear markets of the two of the three largest indices. So S&P, NASDAQ, yes. The Dow, not yet. But why am I bringing this up? Why is this relevant in today's current market environment? Is because, again, the S&P is down around 20% year to date. Well, it's interesting, if you look at history, the same thing happened where the S&P was down 20% year to date in the first leg down of a continued bear market. It happened in the 2000 timeframe, so March 2000. That's, of course, when we had the dot-com bubble peak. So through March 9th, 2001, the S&P lost around 20%, 19.3% to be exact. From October 7th, 2007 to September 19th, 2008, that was the global financial crisis. The S&P lost 19.8, again, around 20%. And from 73 to 74, from January to January, The S&P lost around 18.8%. And of course, we all know in those three timeframes, in the dot-com bust, the financial crisis, and in the early 70s, things got a lot worse. Now, I often talk about in these videos that if you study market history, it tends to give you some indication of what is possible or probable, because sometimes or many times markets tend to repeat, let's say, tendencies. So, for example, if we are going to get, more downside, there is precedent, given, what we've seen in the past with these particular years, that it's possible, I should say, that this is the first leg down. Again, if we're studying history and if history is any guide. We often get the question, do you think the worst is behind us? Now, of course, as I noted earlier, it's difficult to predict these types of things. I would imagine investors back, around the dot-com, the first leg down of the dot-com downturn, or the financial crisis, or the bear market of 1973, it's my belief that investors tend to be generally optimistic. So when one thinks the worst is over and there's a certain level of pain, again, the Nasdaq's down over 30% this year. Again, the Nasdaq, of course, the Dow down around 10. That doesn't feel good. Of course, the S&P, as we noted, around 20. So people tend to think, in my opinion, that, okay, well, maybe the worst is behind us. But remember, there is a real possibility that we're still in the middle of a sustained downtrend where, in my opinion, there's a reasonable chance things get worse. Why? Again, this is just my opinion. You have rising interest rates that, of course, the Fed has continued to focus on taming inflation. So they're continued to be committed to raising interest rates. That is not good for growth companies. Growth companies is what we really need to lead the equity markets, in my opinion. So that's not good. We, of course, have supply issues, which leads to higher prices / inflation. And then, of course, we have a weakening economy and a consumer that, as you know, I've mentioned this a number of times, is dealing with inflation issues by putting money on credit cards. So they're starting to slow their spending. This is just, recent data. But in the time frame where inflation has bit them, on average in the last 2 years, and wages have not kept up with inflation, people are spending money, but again, putting it on credit cards. So we have the largest credit card debt in the history of our country. That is not a good equation when you have the combination of a down market, you have a slowing economy, and of course, wage growth is quite weak. So I don't want to be negative, but I have to be real, in my opinion, with you. So all I have to say is there's a very real probability or possibility that we're just in the midst of a storm. In other words, that the storm is not over. You could see, again, we're still in a sustained downtrend, and a possibility, in my opinion, that if the past at least looks like or is similar to what the future may hold, there is a real chance there is more downside. So I hate to be the bearer of bad news, but I'm a realist. And if you are a client, we speak direct and we speak the truth. If you're not a client, certainly if you would like a second opinion and to see how, your portfolio is doing, how it stacks up relative to where we are in the marketplace, this is our website. You can go on our website at nicholswealth.com, click on the upper right-hand tab, this Contact Us tab, and fill out the information, and one of our advisors will get to you and hopefully provide you some clarity and hopefully some peace of mind in this challenging market environment. Merry Christmas, Happy Hanukkah, Happy Holidays to you. Thanks again for watching. Bye-bye.